Good afternoon and welcome to the Artisanal Spirits Company investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Andrew Dane, CEO. Good afternoon, sir.
Good afternoon. Thank you very much all for joining. I'm Andrew Dane, I'm the Chief Exec. I'm joined today by Billy McCarthy, our CFO. Good afternoon. And it's a chance for us to talk about the interim results for the half year ended 30th of June 2025. And before we get into the details, what we'll do is we'll set out the plan for today. We're going to start with an introduction and overview of the business and an exec summary on the results. I'll then hand over to Billy, who'll take you through some of the trading update. I'll put some strategic context to that update, and then we'll finish with a bit of a current trading update and outlook for the balance of the year. First of all, as a reminder, the Artisanal Spirits Company creates and sells limited edition outstanding whiskies and experiences around the world. We primarily do that through the Scotch Malt Whisky Society. Over 40 years old, with over 40,000 members around the world, the heart and soul of the business. But we've been expanding the group with the acquisition of Single Cask Nation, a US-based independent bottler in January of last year, the launch of the Artisan Casks, high-end private cask experience offering, which launched in July of this year, which we'll talk about a bit more in this presentation, J.G. Thomson's small batch blended malts, and a range of other services like trade cask sales, third-party bottling services under the broader Artisanal Spirits Company banner. All around whisky, all around creating and selling those outstanding limited edition whiskies and experiences around the world. And in terms of the headline, the period, overall described it as a sort of resilient performance. Headline revenue was down 4%, primarily driven by a delay to US shipments as we implemented a new route to market to mitigate the impact of tariffs, and Billy will talk about that. But despite that, headline profitability was flat year on year. As a business, we continue to have a substantial asset backing, over 18,000 casks with a market value of around £100 million, but we're realising more value out of those continued trade cask sales, launch of that new private cask programme. But the core of the business is around selling bottles. And we have a globally engaged SMWS membership base with high retention levels and increasing engagement levels in core markets like the UK, where we've seen the underlying improvements in average bottles per member, good metric of engagement, increasing pretty steadily over the last 15 months. We've also seen growth in recruitment, particularly in the UK, which is up almost 40% year to date, supported by partnerships. And particularly in the UK, the launch of a partnership with Amex, which ran for a few months into Q3, and during that period we recruited almost 1,000 new members via Amex. On top of that, continued international expansion, and that's both through SMWS with the launch of the new Vietnam franchise that was out in June, as well as signing of a new franchise agreement with India, with the first shipment to go in the coming months and the launch thereafter, as well as other brands. So Single Cask Nation exporting into Brazil for the first time, for example. So a number of bits of strategic progress across the group. So now I hand over to Billy, give you a little bit more detail on some of the financials.
Thank you, Andrew. So yeah, Andrew's given a headline there, and I'll take the opportunity to just go into a little bit more detail to bring to life. As we mentioned, overall, the reported revenue was down marginally 4%, but we're keen to call out the situation in America in the first half. So excluding that, our revenue, excluding that America's number, was up 6% year on year, which again, Andrew described well as a resilient performance. Trading conditions are challenging, but we are doing everything we can to manage that. So firstly, on that America's piece, as Andrew said, we basically shipped around half the amount we did versus prior year, which is about £1 million impact in the first half. But if I focus on some of the other regions now, you'll see we break it down into Europe, Asia, and then what we call other, which is essentially Australia and a couple of our franchises in New Zealand and South Africa. So building on Europe, you can see there was a 20% growth, just over 20% growth. Now, a lot of that driven by our cask sales, which remains a strategic priority for the business. That essentially doubled its volume of sale compared to the previous year. and will continue to be a key factor in our delivery of the balance of the year. And it predominantly represents trade cash sales, but we will go on to talk about some more of our private cash sales shortly also. From a venues and events perspective, we're really pleased that that delivered 6% growth year on year. Talked about challenging conditions, but venues and events continues to be able to achieve growth year on year. So we're pleased about that, and 6% is a good return. And then finishing in the Europe region, what's left is basically our UK online and our Europe online e-commerce. So that was down 8%. From a UK perspective, that was roughly flat. Had a very strong Q1, but had a bit of a tougher Q2 to end the half flat. In Europe, the conditions have been a bit more challenging, but we've seen a better start to Q3, so of which we'll mention a bit more as we go through this presentation. In Asia, it does show 30% decline, and Asia is definitely a challenging market and has been for 2 years. However, that impact is a factor within that is shipping timing within China. Some of the releases we had planned to do in the first half, shipping delayed into the second half, means that more of the delivery will be in the second half, and we don't expect it to be a 30% decline in the balance of the year for Asia. And again, we'll come on to talk about each region individually shortly. But overall, resilient performance, lots to come in the second half that we'll talk about. Now, as trading conditions are challenging as a business, we want to deliver EBITDA. Last year, we delivered our first full positive EBITDA of £1 million. This year, the expectation of £1.5 million. To allow us to deliver that where challenging trading conditions exist, it's important we manage our cost base and drive efficiencies where we can. And the purpose of the slide you can see on the screen at the minute is to show we've done just that. We recognise 4 key areas of spend in our cost base. So commission, marketing, payroll and overheads. And across all of them, we've achieved a 10% reduction year on year. And across all of them, we have achieved efficiencies. And if I was to go into each one individually briefly, commission is as a result of taking greater control of the US market, taking on a US team as opposed to paying a partner commission. So there's savings there. In marketing, we continue to try and drive increased return on investment, making sure the focus is on the short term. So recruitment and retention, that's really driving bottle sales and making sure we can deliver in the short term. And then on overheads, it's about managing things appropriately. So reducing spend on professional fees, reducing spend on recruitment fees, as our employee value proposition has really increased the last couple of years. Our spend with agencies has significantly dropped, which we're pleased about. And from a payroll perspective, you can see on the screen there is a net increase, but what I would call out there is a significant impact of the national insurance increase, which for this business is about £100,000 a year. And also I mentioned 2 minutes ago, the fact that we took on the US team, which in the first half was a cost of £500,000. So you can see we've actually driven efficiencies of around £300,000 to reduce that net impact of those increases to simply £300 additional spend. And finally, for me, before I hand it back to Andrew, cash and net debt. First thing I would say is the net debt of this business does go in a bit of a peak fashion. At half year, due to the half two weighted nature of profit delivery in this business, it does slightly increase. By the half year, that will reduce as you would expect. If I was to call out key parameters of that increase in half one, as I've talked about, certainly the EBITDA loss year on year flat from an adjusted perspective, that obviously utilises cash. We've also made, and I referenced 2 minutes ago, that significant investment in the US, which is £500,000 on SMWS America and a couple $100K to close out the acquisition of Single Cast Nation from an earnout perspective. Other than that, there's a little bit of creditor timing, but ultimately that's the driver to the half year. As we deliver profitability in the second half, that net debt will come down at least a couple of £1 million in line with analyst forecasts. Brilliant, thank you.
Thanks, Billy. So if I now move on to talk a little bit about the kind of strategic context, and we think about strategy through 2 lenses. First of all, a regional approach, talking about those key regions, Europe, Americas, Asia, and the rest of the world, and then through global set pillars that apply everywhere. So first of all, picking from a strategic perspective, the regions, and with our largest region being Europe. Headline looks positive, Europe up by over 20%, but that's really driven by the strong cask sales. In addition to that, though, pleased to see the growth in the core venues and events offering. And as Billy said, while there was a slight decline in e-commerce, actually the underlying momentum is improved. So UK is our largest market. And what we're seeing in the UK is venues and events growing high single digits. UK online has been growing well into the second half. So we're seeing double-digit growth in H2 to date. We've seen almost 40% growth in new membership recruitment in the UK. So the business fundamentals remain strong there. We also see good retention across the markets and opportunities for partnerships, etc., to expand in our key market. But here at home, core business performing well, with opportunities in mainland Europe to expand. Oops, I just skipped on. Next up in America. Here, what is important to note is we are making strategic progress, but we are experiencing very challenging economic headwinds, particularly from around about the Q4 last year as the kind of presidential elections came to light, early into this year into tariff impacts. So what we've seen from a strategic perspective is the change in our setup, as Billy alluded to, bringing in-house the marketing and operations team. From a cost-saving perspective, good payback. From a culture perspective, really good integration of the team. From an execution perspective, the team are delivering well, responding well to our direct control, to shareholder, to member expectations. So addressing key concerns the members have had, like flat rate shipping costs, in specific bottle prices. Those have really helped. And those have actually helped to drive average bottles per order up, average selling price, and therefore average order value up, all up year on year and ahead of budget. Where the challenges come is twofold. First is that recruitment has been more challenging in the current conditions, and we're having to flex and adapt. Now, we're having some success in the initiatives that we're launching into H2. So August was a record ever month for recruitment in the US. We're targeting whiskey clubs, whiskey influencers, and in September, we're launching a loyalty program in the US. So those are having some positive impacts. But also what we're seeing as a challenge in the US is essentially there's two impacts from the tariff. The first is the direct costs of the import tariffs, which the team have done a great job of mitigating. So this year, the cost will be a couple of £100,000, a little bit less like next year, which is painful for a business of our side, but not catastrophic. The bigger challenge has actually been the indirect impact of the uncertainty in the market and what impact that's had on consumer confidence, particularly with discretionary spending. So we've seen a pause with members in terms of spending. That has started to ease into H2, but it's still a challenge in the market. But what's important is while that creates short-term performance challenges, which Billy and I are managing in the normal way, it doesn't create any challenge, I think, to the long-term or medium-term strategic view that the US is still the world's biggest premium whiskey market, and our specific opportunity in that market in the next couple of years is substantial, and we have the right team, really good brand quality, brand reputation, and execution in the market to grow significantly in that market over the coming years. From an Asia perspective as well, as Billy was starting to allude to, it had been a challenging market, particularly in China over the last couple of years. Our business is now slightly less than half of the size it was a couple of years ago. But my view is we are seeing that now bottom. So H1 was down in part due to release timings. But actually, as you look into H2, we've had double-digit growth in August. I'm expecting pretty substantial growth in September. So that should feed through into relatively flat performance in H2. So bottoming of that curve in China. And I still think that while we're not assuming that market conditions improve, we're now hopeful that the risk is to the upside in that market, where, remembering, if we were only able to get back to where we were a couple of years ago, that's another couple of £1 million of profit in the business. So we're not assuming that that comes through, but that is an opportunity if we can get that growth motoring again. So then alongside the kind of key regions, we then have our strategic pillars that sit globally. Whiskey, membership, experiences, new brands and audiences, and our people. And I'll touch on a kind of couple of key initiatives across each of these. First of all, what I'm really excited about, we've mentioned it very briefly so far, and that's the launch of our Artisan Cask private cask offering. So you're going to get a chance now, if the system works, to watch a short video that introduces this. So QVT.
At Artisan Casks, what we're all about is elevating rare Scotch whisky to the incredible level that it deserves. This experience here today is what I think brings together everything that's most special about Scotch whisky. Artisan Casks is the new luxury private cask program featuring mature, exceptional quality casks of impeccable provenance, looked after by the Artisanal Spirits Company. The thing that brings the most value to a cask owner, the experience of what it's like to be an owner. And that's really what sets Artisan Casks apart. It's incredible quality whiskey from impeccable provenance, but with an experience like no other. It is one of the true luxuries in life.
So hopefully you enjoyed that introduction, glimpse into the private cask offering. And just as a reminder, all of the private cask sales that we're talking about are all about an individual, a group of individuals, buying a whole cask worth of bottles. So this is not a cask investment scheme. They don't get the rights to the cask. They can't resell it. It's about buying a whole cask worth of bottles. But particularly for this initiative, actually, what we found is, in addition to a truly impeccable rarity, exclusive product with outstanding quality, actually where we as a business can bring extra value is in the experience that goes with that. A true luxury experience offered to the cask owners. And that has been a real insight, and that's really resonated with the market. And that's been led by James Mackay, who you saw on the screen there, who joined us in January, having spent the last decade or so leading Diageo, rare and exceptional whiskey brand, as their global private client director. So it's been a good addition to the team and launching this. We obviously spent the money and done the work in H1 in terms of brand development and launch, which I think is fantastic. But that launch event really started in July in Monaco, followed by Singapore and New York, and in the next couple of weeks in Dubai. That program is starting to work. For a few £100,000 worth of sales starting to come through, but a lot still to go to hit the kind of £1 million mark by the end of the year. So that's the first part from a whiskey perspective. The second is from a bottle sales perspective. Members, I thought it was worth just touching on Creators Collection. So this was one of the parts of the range review outcomes, which has been successful so far. So Creators Collection, we launched our first one at the tail end of last year. And those have gone from strength to strength. And the most recent release, called the Worm Tub Trilogy, celebrating whiskies from distilleries that use worm tub condensers for that really robust flavour, really resonated well. So in the UK, selling out in a month, in the EU in a week, in the US it sold out in an hour, and in China in just over a minute. So even in markets like the US and China, which are having kind of broader struggles, where we have great quality products, great quality storytelling and execution at a good value price point, that doesn't mean low price point, but good value price point, those are still cutting through. And that's what we're pushing more and more to drive growth. So that's the first pillar on whiskey. Second is on membership, and how do we grow and deliver a step change in membership. Part of that was one of our 3 key focus areas for this year. So they were America, launch of the private cask program. The third was around that step change in membership. And as part of that program, one of the pieces was to look at partnerships. And actually here, Matt Bailey, our Australian MD, who came across to Europe on secondment for the last year or so, helped to bring across a partnership that had been successful in Australia, now working in the UK with Amex. And in short, over the space of a couple of months, we recruited almost 1,000 members into the UK with, from a fully loaded cost base, essentially net neutral cost of acquisition, actually made a slight profit on the program. So a good recruitment tool generating value. Alongside that, as we look ahead, what we've been working on is how do we bring people into the society, making sure that whiskey-led messaging about VIP access to outstanding whiskies really resonates. And from a product perspective, that means that every new member should get whiskey in hand, liquid to lips as soon as possible. So we have an outstanding membership and bottle product, which we've been selling on our own site. But actually, for the first time, we're going to take that product, a recruitment product, and sell it on Amazon in the coming weeks. And what that will do is use it as a recruitment channel. It's still £100, same price point as it would be on the UK site, but as a way of attracting, attacking a new audience, particularly the gifting audience through that key Q4 trading period. So hopefully that should help to drive engagement and bring people into the world. It's important to note, as I say, it's not a sales channel, it's a recruitment channel to bring people into the S&W store that otherwise would not have encountered it. Third pillar is around experiences and how we bring those experiences vary across the world. Just talked about Australia, with the Australian Camps Whisky Tasting Festival, which is all run by SMWS. There is one of the biggest events in the whisky calendar there. Hundreds of people from across the industry, all under the SMWS banner, about the flavours and taste of the whisky. So that's a great event. The other two photos beside that, the kind of bottom left and top middle, are from an event I was at in Guangzhou, where we had almost 350 people at that event. The bottom, you've got Single Cask Nation guys, Harry Fry, Jack Rose in Washington, I believe. And then Nick Fulton on the right-hand side, who's our new group head chef, who's been changing the food experience offering in venues, really elevating the quality of the food, but also importantly, the alignment of the food with the whisky offering. Because what we want is the food to enhance and elevate the whisky offering in the venues. And as you can see from the results, that seems to be working. From the fourth pillar, it's around new brands and audiences. And here you can see how a few of these recent developments over recent years, we've launched in Taiwan, third on that list, launched in South Korea, fourth on that list, and this year added Vietnam, seventh on the list as a new franchise, signed a new agreement with India, which is 15th, but growing fast, but also started our first exports into Brazil. It's important to note that while I don't expect any of these markets to move the needle in the short term, we're talking tens of thousands of pounds in the short term, they all represent opportunities to seed markets as those markets expand. India is a good example where the current discussions on the agreement would be for tariffs to come down from 150% to 75%, but it's still a very high level overall compared to other markets. So a chance to get used to importation, working with a great partner, testing out provinces, whether Haryana versus Gurgaon or whatever works best for us, what the best hotel chains, the best way to bring the society to life in the market, and testing and learning and developing those as we look for longer term growth in those markets. The fifth part is about our people. Billy touched on our employee value proposition having strengthened. Importantly, we do an annual staff survey. We've got the best result for a long time there with an employee engagement score of 80%. Now, our sort of survey platform says anything over 70 is a good result, up 5 percentage points year on year, as we really focus on an outstanding culture for the business. And as I said earlier, we've also strengthened the executive team with James Mackay joining, previously Global Private Client Director and Head of Rare and Exceptional Spirits for Diageo, and Emily having joined us as our new Marketing Director last week, formerly a Director at the Stripe Agency, and another brilliant addition to the team as she really hit the ground running over the last couple of weeks. Bill, if we maybe turn over to you, you could talk a little bit about capital structure and how we look at the use of cash.
Yes, thanks, Andrew. So as we continue to grow and grow our profit and therefore grow our cash generation, I wanted to bring to life a little bit how we consider where we allocate that capital. So we break it into two parts: operational use and strategic use. Ultimately, the investment in operational use is to drive growth of profit and cash in the business. So from a marketing perspective, ensuring we're investing enough in marketing to make sure that we're increasing recruitment and retention, but also reaching out, building the brand and reaching out to new potential members. From a cask spirit perspective, we don't own a distillery. We buy our whiskey from every other distillery in Scotland and from others around the world. So we need to continually be looking to invest in the right areas to make sure we have the right portfolio going forward to meet demand, but also where some prospective opportunities exist regarding returns on that cask spirit, and I'll go on to talk about that in a second on the next slide. And thirdly, from an operational perspective, CapEx. That has been lighter in recent years where the challenging trading conditions exist, and we haven't put as much into that as perhaps we have in prior years, but that's always an opportunity. A real life example potentially being were we to open a new venue. That's where significant CapEx go. And on the right hand side, the strategic use, we're very clear that we are not uncomfortable with our net debt position, and I'll explain that a little bit more on the next slide. But we are comfortable in marginally reducing that over the next few years as we do generate more profit and generate more cash. So that's one area we're definitely looking at in the short to medium term. And then probably perhaps on the longer term at the minute is shareholder returns and M&A, where cash is, as I mentioned, is tighter in challenging conditions. Those are much more of a longer term objective after we achieve the profit and cash growth that we're looking for. So if I go on to talk a bit more about that cask spirit side of things, as a business, as I mentioned, we don't own a distillery, we buy all our whiskey. Currently, they're just under 19,000 casks we currently hold on our books. They were bought for a total of around £28 million, and that's what sits in our balance sheet. Our strong balance sheet, a balance sheet with £28 million of assets on it is fantastic. However, it's important to note that when we buy whiskey, we do tend to mature it. So whether we buy it when it's new make spirit, mature it for a number of years, whether we buy it when it's a bit older, still mature it longer, that asset appreciates. And if you took those 19,000 casks and did a true market valuation on it, you get the bottom bar chart there. So last year we did an independent valuation, sort of appointed somebody to do an independent valuation for us, which valued those 19,000 casks at £100 million. Now that's really helpful to show the underlying strength of this business from an asset perspective. It's also helpful when we measure it against some key comparators. So for example, our market cap is currently just over 30 million and enterprise value is just over 60 million. That asset valuation does seem out of sync, and we're key to highlight the underlying value of this business to try and show that there is opportunity for greater valuation in this business from a share price perspective. And the last bit on this I'll finish on, what's also helpful as a comparator, if we were to look to sell these casks under a quicker approach, so for example with the bank, we have our financing facility, they always do a valuation each year through an independent company that says, if we need to sell casks quickly in an orderly liquidated value, how much would we get for them? At £50 million, that's half the market valuation, but still nearly double the net book value. So it's also a helpful comparator just to show the asset value.
Thanks, Ben. And on this page again, it's important to note that our strategy is to generate value in two stages. The first of which is that capturing the appreciation and inflation of the asset, and that part of the strategy has been very successful. We've spent £28 million on an asset that's now worth £100 million. But ultimately, it's only worth that if we can sell it and realise that value. And primarily we want to do that by actually taking the £100 million worth of casks, and that in bottle value is about £500 million worth of retail values of bottles that we own today. So the objective is to put those casks into bottles and sell them as fast as we can. Now in reality, in the short term, we're making some balances, we're realising some more value from those casks in the short term, but trying to still capture much of that 100 million by doing it in a managed way over time. So if I wrap up with kind of current trading outlook, and then we can move on and take a look at some of the questions. So first thing to note is that trading in H2 today has been in line with expectations. So it started in line. That Artisan cask, which launched in July, started to gather some momentum. Lots still to deliver in H2, but some good early signs of success. Preparations are underway from a product development and innovation perspective for the next phase of our range review in the coming weeks, as well as new signature range. We were also going to have additional creators collection releases and heresy range releases. Then what you're going to have is to deliver our full year guidance, which maintains the EBITDA focus of 1.5 million. These three things we're focused on delivering to secure that. The first is single digit growth in SMWS bottle sales over the balance of the year. We've got a reasonable degree of confidence in that. As I say, China's up double digits in August, UK's up double digits, EU was actually up double digits in August as well. So good confidence in the core bottle sales part of the business delivering. Then you've got the delivery of the greater year-on-year US shipments. Now that our new route to market is in place, those shipments are starting to go. From a commercial perspective, it's good. From an operational perspective, we're producing that stock now. So there will be a slight stock build in the US in the second half of the year. But that stock that will primarily be bottled now in the new livery and shipped into market in Q4. And then finally, the lumpier part of delivery, which is around that significant margin return from cask sales, both from the private cask sales, which as I say has just started and is gathering momentum, but also from trade cask sales, where we've already delivered 2.5 million or so today. Got another one and a bit to go. But those are a lumpier part and they need delivered to hit the numbers for this year as well. So overall, the market conditions remain tough. We are managing through them. We're still delivering profitable increase in profit, managing our cost base in the short term, making sure we're taking advantage of the opportunities that are in front of us while having a cost base that suits the short-term growth expectations, but still with a business with substantial opportunity for growth over the medium to long term. Okay, thanks so much. And I'm happy to move over and take some questions.
Andrew, Billy, thank you very much for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Yeah, no problem at all. So first of all, I'll start with a question which says, please can you explain the share price performance over the last 3 years? So obviously, it's important to note we don't control the share price. What we control is the company performance, and our investor comms and hopefully get that across. What you've seen since our IPO is the AIM all share index down 40%. Spirits, large spirits companies, Diageo, etc., down around roughly 40%. Our share price is down about 60%. So part of that is a reflection of the market conditions across it. Part of it is our own performance, where we haven't delivered the full growth that we said we would deliver at the time of the IPO. Now, while we were on track through 2021 and 2022, as conditions started to become more challenging in 23, we've had to adapt and flex. And while we have still delivered profitable improvements, they haven't been of the scale that we set out at the time of the IPO. So we are working hard to still make sure we are delivering profitable growth, though the timing and magnitude of that is slightly slower than it was that we'd hoped to achieve at the time of the IPO. So that's the best I can give insight there. But as Billy says, two things feed my own perspective on this. First is there is a significant gap between the current kind of quoted share price, which is based on a pretty illiquid, but the kind of current share price, and the board and management team's expectations of the real value of the business over time. So it's our job to try and close that gap. First of all, by improving company performance. Second of all, by engaging with investors to help close that gap. So that's the key insight probably on share price. Second question says, there aren't many businesses where the stock gets more valuable over time. The external valuation is a helpful marker, but I largely ignore the in-house retail valuation, as no data is provided on the age mix of casks. More info about the stock value would be helpful. So here we do try to share some information, and as I say, that's one of the reasons that we've got external valuation of the stock to come up with that £102 million number last year. From a retail perspective, that's a very crude working. We literally say the 19,000 casks represents 5 million bottles worth of liquid. Our average sales price of liquid is £100 per bottle ex VAT. So £100 per bottle times 5 million bottles worth of liquid is 500 million. You're correct, it doesn't reflect the actual mix of ages and casks and distillery and so on, but it's a very crude working. But as an order of magnitude, it helps get some guidance. You know, bit more insights into the casks. We own casks from over 100 different distilleries, from over 200 different makes, so peated and unpeated being different makes. A huge range of vintages, from new make spirit made in 2025, way back into the 70s and 80s. We also have now over half of the stock that we own now was bought when it was either new make spirit straight off the still or young spirits less than 3 years old. So most of the spirit that we now own has been bought when it was at that age of the spectrum. So hopefully that helps provide a bit more insight into the stockholding. So the next question says, I understand that the Amazon tie-up is about driving new members, but for a premium product, is there not a danger of diminishing this by associating with Amazon? I mean, it's worth noting that Amazon do, while their spread of demographics is different to ours, they do cater quite a lot to the premium space. So that's about our execution. How do we bring that to life and our quality of delivery? And I think for a business of our size, I think it's right that we test new ideas. We've been working on this for months. We've got the quality of the execution. We've been consulting with members and people across business to make sure we deliver it in the right way. But I think that that's on us to make sure it's a premium offering, delivered in a premium way. Recruiting £100 bottle of membership, it's clearly pitched at a different place to an entry-level gift, but we do think that there is a real opportunity there and well worth trying in the balance of the year. Okay, next question, so I'll flip back up to the top. The company has a strong focus on adjusted EBITDA as a measure of profitability, but when can shareholders expect the business to generate an actual profit? So you're absolutely right, and this has been a trajectory over time. When we first IPO'd, the measure of success was revenue. top line was growing at 20%. As we transition that through, the metric of focus at the moment is, can we get to EBITDA as a proxy for operating profitability of the business profitable? And that's the trajectory we're on just now. Over the next couple of years, that focus will absolutely shift to real profit, genuine bottom profit after tax over the next couple of years. It's worth noting, though, that unlike many businesses, we have quite a significant non-cash cost of sale. And that is, as we bottle and sell the liquid, we recognize the whole value, that net value goes through as a cost of sale, but it's non-cash. So actually, we are focused both on profit after tax, but actually, I think we will get to operating cash and actually probably net cash positive before we get to profit after tax. So we are focused on, first of all, driving EBITDA as a measure for operating profit. Second of all, getting positive cash, bottom line net movement in net debt over the next year or so, and then on to proper profit after tax. And it's worth noting that some of those, the bits below EBITDA, depreciation, etc., Masterton will be fully depreciated relatively soon. We have quite a substantial unrecognised deferred tax asset. So that path through to proper bottom line profit will be faster than you might think once we turn around. Next question is for you, Billy.
Yeah. So the question, please can the CFO provide an update on how the refinancing extension of the company's borrowings is progressing? Is the margin on the RCF from RBS and the inventory financing from Ferrabina expected to remain at 2.25%? So at this minute in time, I can't share too much information, but I can say that we are in the process of refinancing. So as a reminder, the current RCF agreement with RBS finishes in June of next year. We will be closing a new refinance long before that. And the expectation over the next month or two, we'll be able to confirm what that is. In terms of an interest rate level of 2.25%, it's not a bad interest rate level. I would like to reduce it a little bit. I wouldn't expect significant movement, but I think there's opportunity to do that. What we'd like to achieve is, instead of two facilities, is one fully combined facility at a competitive rate. And it's one we are making progress on and hope to update you on over the next few weeks or a couple of months.
Okay, thanks, Billy. Next question is there a date for when the next independent valuation of the inventory will take place? At the moment, I've got no plans to do that. Essentially, the exercise was more about putting a marker in the sand about this absolute magnitude. And whether it's 102 or 92 or 122, the point is it's a substantial difference from the net book value. And actually paying money to an independent valuer in the short term to keep that updated, I don't think has value. So from a cost perspective, I think having done it once, we got the message. Over time, we'll stop using that if we think it's too outdated. But at the moment, there's no plans to release that. The next question, have you thought of part cask sales? See some distilleries sell 3 bottles from a cask. So what we have decided is that, obviously you can buy 3 bottles from a cask as part of our normal business model because everything we do is single cask. What we thought about whether we should offer from a cask sales, particularly the 50th Cask Club, where you and your friends can group together and buy a whole cask worth of bottles, which will be bottled in 2033 as part of our 50th anniversary. You get to be part of the journey of maturation. You basically get to buy in at new make prices. So that's sort of £4,000, £5,000, £6,000 per cask. We thought about offering that in where we control a syndicate of buyers, but actually we decided that it was easier to just to push the syndication onto the members. And that's what we found people have done. They've basically grouped together with friends, 1 friend, 10 friends, 100 friends, however they want to split up and own a cask together. So I think that's an easier way from an operational excellence way of delivering that. Okay, the next question. What are the board and the company's brokers doing to attract new shareholders to drive demand for the shares and increase the share price? So there's quite a few parts to the strategy. So first of all, overall, the long-term value of the business grows best from delivering improved company results. So that's our number one focus. Let's get the business making more profit, more cash, and on a growth trajectory. That's what drives the most value. In the short term, we are doing all the normal things. We're doing investor roadshows. We're engaging both with our existing institutional investors as well as targeting new investors. We're in the middle of the interim roadshow. We've met a few holders, a few non-holders, some more to come. But also one of the areas of strategic focus for this year was the retail base. As you may be aware, the liquidity in our shares is pretty low. So actually bringing in a new big institutional investor is quite challenging, even if they like the economics. So what we've been doing is trying to drive volume and liquidity through the retail base. And there's a few strands to how we've delivered that. First is more investor engagement. So that means we relaunched our company website to make it easier for people to understand and engage with the company from a PLC perspective. We've done more events like Investor Meet Company, Mellow Mondays, more outreach like that. The third is a flow of news, so RNS reach notifications about company awards, launch of Artisan Cast, entry into new markets, keeping the RNSs, the kind of core messaging, focused on the big ticket results, but a steady flow of RNS reach so that people understand what's going on in the business. That has been reasonably successful. If you look at our share price year to date, we're outperforming pretty much any of the benchmarks, but we need to continue to keep the foot down on those. So those are the real areas that we're focused on. Next question. Are our non-whiskey offerings working in bringing a different demographic of members in significant numbers? The short answer to that is no. They're a piece of intrigue. Single cask spirits, armagnacs, cognacs, gins, rums. We know that people who drink whiskey don't just drink whiskey, they drink other spirits. I think there's a simpler way to bring gins and rums to life for the society members rather than Scotch Malt Whisky Society single cask spirit rum. It's a slightly confusing proposition. So I think we can simplify that offering, but the core of the business remains about whiskey. So little bits at the edges on the others, but the focus is really continues to be on whiskey. The next question, have you considered releasing a small part of the casks to prove the independent valuation of the stock with an actual bid and pay down a bit of debt? And we haven't just considered it, we're actually doing it. So if you look over the last few years, cask sales, trade cask sales, where we're taking those casks, selling them to trusted industry partners who are going to bottle and blend them themselves, we've been doing that. And it's gone from a few £100,000 a few years ago to a couple of £1 million in 2023, £3 million last year. It'll be more like £4 million this year. So by the end of this year, we'll have sold the thick part of £10 million worth of casks. And those have been sold materially in line with the independent valuation. Some up, some down, but materially they've been in line with that independent valuation. And that's been used not just to manage cash flow, but to invest in the other areas of the business that we think will deliver long-term growth. And this was Billy's point about operational strategic uses. Where we've had a little bit of cash, actually we've said £500,000 investment in the US next at the start of this year was well worth it. 18 months payback on that investment. There are other areas where we thought that's a really good place to invest. So we've been doing that. We will continue to do that to deliver value. Next question, is Whisky Invest Direct a competitor? There are lots of whisky businesses out there which compete with elements of our model. There are whisky clubs, but they tend not to own their own stock. There are independent bottlers, but they don't have the membership model or the breadth of our inventory. There are proprietary brands. So there are people who compete with elements of what we're doing, but no, I don't see them as a competitor to our whole global business model with the diversified brands and SMWS's membership model underpinning global bottle sales. So they're within the broader competitive set. They're in whiskey, but I don't see them as a kind of direct competitor. Okay, I think that's all the Q&A complete, unless there's anything more from anyone else.
Andrew, Billy, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Andrew, could I please just ask you for a few closing comments?
Yeah, absolutely. So first of all, huge thank you to you all for joining. As I say, it's a business in good health from a people perspective, from a brand perspective, encountering some short-term industry challenges, but navigating through those, still delivering profitable growth with an outlook where we're going to deliver single-digit bottle sales growth, delivering those US shipments. And if we can deliver the trade cask and private cask sales in the balance of the year, we can deliver full-year profit, which represent almost a 50% increase full-year profitability, and then building into long-term substantial opportunities for the business longer term. So really thank you for all your support, and please do answer the poll because your feedback really does matter to us. Thank you very much.
Andrew, Billy, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team could better understand your views and expectations. This will only take a few moments to complete and I'm sure will be greatly valued by the company. On behalf of the management team of the Artisanal Spirits Company PLC, we'd like to thank you for attending today's presentation and good afternoon to you all.